evening, fellow RFCs and our guests. I'm Boyet Benavides, welcoming everyone to the 7th episode of Season 4 of our RFC Tuesday podcast. And joining me tonight is Kuya Ryan Daes. For Season 4, creating a resilient investment portfolio, today's episode, our episode 7, highlights the venture into hedge funds, a field guide to hedge funds. We are about to cap Season 4 that we called creating a resilient investment portfolio. We have tackled both traditional assets, non-traditional assets, in terms of tools that we can use for our client's portfolio. So today, our final episode promises to be a very exciting one. We have been experiencing a roller coaster ride with many markets exhibiting volatility, and this makes our season very relevant right now. Tonight, we will explore the world of hedge funds from our very dear friend Gerald Valdivia, a very good friend of IRCPH.
Before we start, we thank the IARC Philippines, the Philippine chapter of the International Association of Registered Financial Consultants, for putting together this podcast. The IARC Philippines is an association dedicated to the craft of financial consulting. The association is the sole organization authorized to conduct the RFC conversion courses as well as continuing education in the field of financial consulting. We are your hosts tonight. I am Kuya Ryan Daes, a registered financial consultant, a chartered wealth manager, and a registered estate planner.
And I'm Boyet Benavides, a registered financial consultant and a certified trust professional. Tonight's guest is a seasoned market practitioner, a very good friend, and a pioneer in the asset management industry. Gerald Valdivia was executive director at ATR Asset Management, or ATRAM, where he was involved in portfolio analytics, risk management, marketing, and sales. Earlier, Gerald worked on project finance and private equity, covering investments in the Philippines, Thailand, and Vietnam. At the International Finance Corporation, the private sector arm of the World Bank Group. He also had a stint as equity analyst at Societe Generale and at ATR Kim Eng Peregrine Securities, trade and political risk insurance at AIG in New York, and credit at Far East Bank and Trust Company. He has been a speaker and panelist at private equity, liquid equities, and project finance conferences in the Philippines and abroad. Gerald earned an MBA at the Columbia University and a Bachelor of Science cum laude degree in Business Administration at the University of the Philippines. He's a board director and the president of 7 of ATRAM's mutual funds, having a total AUM of $68 million. So, fellow RFC and guests, let's all welcome Mr. Gerald Valdivia. Gerald, can you tell us what the hedge fund is, how it differs from other kinds of funds? If we encounter such an animal, how can we tell whether it's a hedge fund or something else?
Thank you, Boyet. The use of the term animal, that figure of speech, is interesting because there are many types of portfolio animals that behave as hedge funds. So instead of asking whether an animal is a tiger or a jellyfish or a honeybee, it's probably better for our purposes to talk about the characteristics of different animals that they may share in common, such as whether they are predators, they're tropical or nocturnal. So I think there are a couple of broad characteristics that would tell you that you're probably looking at a hedge fund. The first clue is that the portfolio is either unregulated or only very lightly regulated. Now, if a fund manager decides to establish a fund that has little or no oversight from a regulator, that crucial foundational decision is usually a direct consequence of the second clue, which is the nature of the chosen principal investment strategy or strategies. If a fund if a fund's investment strategy carries with it potential outcomes that retail investors may not be able to fully grasp or have limited capacity to withstand, then the strategy may not be well tolerated by regulators who are mandated to shield the general public, the investing public, from harm. Therefore, the portfolio will have to be marketed entirely to institutions and high net worth individuals who presumably have the requisite sophistication and robust balance sheets. So I know this framework sounds annoyingly broad and vague, but in fact the term hedge fund has become a residual catch-all bracket for all other portfolios that don't fit into any of the major conventional strategies. I should point out that hedge funds themselves have the freedom to hold in their balance sheets any mix of traditional and or alternative asset classes depending upon the chosen investment thesis or management styles. Hedge funds may wish to invest in listed stocks, private equity, venture capital, bonds, private loans, commodity derivatives, fine art, real estate, or anything else under the sun. It's the investment strategy that's supposed to differentiate a hedge fund from all other asset classes. A portfolio manager will choose to put up a hedge fund precisely because of the absence of regulation, to enjoy the freedom to experiment with novel investment strategies and techniques. The sophisticated and often innovative strategies employed are meant to, hopefully, generate either better than expected returns or lower than usual risks or provide portfolio diversification due to low correlations with other investments or accomplish some combination of the above.
That's very interesting, Gerald. So it would seem that hedge funds are not really for small time or even retail investors. So you mentioned a while ago that somewhat it's really just for large investors or even sophisticated investors. Uh, However, where do sophisticated investors go to find hedge funds?
Thanks for the question, Ryan. Hedge fund prospectuses, first of all, responding to your first question about what's sophisticated and what's large. No, the prospectus of a hedge fund will usually specify a minimum initial investment of as low as 100,000 US dollars, so roughly 5 million pesos. But very often the minimum may be above that, maybe 1 million, 2 million, 5 or 10 million US dollars. This ensures, for the most part, that smaller investors are unable to join the party. So I'm not aware of any locally managed hedge funds being marketed in the Philippines. Though, of course, any such local hedge fund manager, they may exist, but they probably would invite as their investor clients only friends and family, given the fact that local regulators would disapprove of any public solicitation. So there certainly are people in Manila that I'm aware of who manage their own monies as if they were hedge funds, the way hedge funds do. But these are what are known as family offices. They have no external investors and they own 100% of their portfolios. The only hedge funds that Filipinos can consider investing in are therefore based abroad. And the legal domiciles of these funds and their managers will be typically tax havens, such as the Cayman Islands, British Virgin Islands, and the like. And the portfolio manager and analyst teams will actually be sitting in the global money centers, such in the US or Europe or East Asia. So that's where you can find them.
Assuming Filipino investors are able to find and contact such reputable foreign hedge fund managers, what can we expect in terms of investor relations, interactions, and reporting transparency?
Well, in one respect, alternatives portfolios, including hedge funds and also private equity and venture capital funds, They're very unlike retail funds such as mutual funds and UITFs because they do not offer the convenient daily liquidity that retail investors are used to and rely upon. With mutual funds and UITFs, you can subscribe and request redemptions on any given banking day, and the redemption proceeds can be paid out 1 to 5 days after the redemption request. So this is possible because mutual funds and UITFs are very liquid. Their portfolios are liquid by regulatory fiat. On the other hand, in contrast, managers of hedge funds prefer to batch investor transactions and subscriptions and redemptions on a monthly and sometimes even on a quarterly basis. In some cases, because the portfolios may be illiquid, since investors can get their money in and out of a hedge fund only once a month or once a quarter, then there's really no need to report the net asset value on a daily basis. It also gets reported on a monthly or quarterly basis. But having said that, I mean, those remarks on the frequency of reporting, it's a fair expectation that hedge fund managers disclose to their investors at least as much as one would expect from a mutual fund. And sometimes you get more regarding what management has been doing with the portfolio. But again, the frequency is a lot less than with funds, with retail funds.
Oh, since you already discussed what a hedge fund is like from the outside, can you tell us more what happens within its portfolio or inside their portfolios? And what are these so-called sophisticated investment strategies all about?
Good question, Ryan. Sophisticated strategies are really nothing very fancy. They're often just a byproduct of surprisingly simple insights. They're moments of clarity that demonstrate that common sense is really not all that common. Obviously, the term hedge fund implies that the objective, or at least one of the major objectives of a hedge fund, is to hedge against unwanted risks. That at least was the key insight when the first modern hedge fund was put up more than 70 years ago by an Australian manager named Alfred Winslow Jones, who lived and traded stocks in New York. So that was around 1949. If you're familiar with the casino expression, hedge your bets, you'll realize that the idea of insulating oneself against potentially unfavorable outcomes outside one's control is already a few centuries old. So, and in fact, that's the underpinning or the bedrock, not only of the gambling industries, the casino industry, but also the banking and insurance industries. And it's not lost on me. The fact is not lost on me that many members of IARFC Philippines do work with insurers. So you're very familiar with the concept of risk. But what Alfred Jones recognized was that in order to enjoy meaningful investment returns, one needs to embrace risks. So there's no reward unless you are comfortable with risks that you know. Otherwise, one would just invest in treasuries, which are by definition risk-free if you hold them to maturity. Although in some periods, including the present period, when inflation is running higher than treasury yields, it's arguable whether such risks are really risk-free. So whether such returns are really risk-free and meaningful. If you're not content to passively replicate an index, then and you want to invest on your own, then you surely have your own opinions and biases. So hopefully these are supported by your own research regarding which investments are likely to do well. And these investments are what you will plan to add to your portfolio. In hedge fund speak, those opinions or biases which you hold are what are called a view. Moreover, I was careful to say likely to do well. That's the relevant qualifier for the investments that you think will do well. This is because nobody can really be sure about the future. In other words, even if you have strong reasons to think that an investment will do well, you're still at the end of the day shouldering a risk, a bit of uncertainty. You're taking a bet. Alfred Jones said that whenever we buy a risky security, such as a stock, we are really expressing a positive view about a bet or a risk that we are taking.
Gerald, it all sounds very theoretical. No? For the benefit of our viewers, maybe you can provide a few concrete examples of how the different hedging techniques or yung different risk management techniques.
Sure. Thanks, Boyet. Let me try to make it more concrete. So let's imagine we have a very basic hedge fund portfolio, which consists of only two pieces: a risk-seeking part in which you make a bet that expresses your view, and a hedging part, which you hope will shield you against other risks, particularly a general downturn in the capital markets. Let's say that your investment thesis or hypothesis is that persistent consumer inflation in the United States could shift spending patterns away from discretionary and toward more essential items. If household incomes don't keep pace with retail prices, many households will be forced to cancel their Netflix subscriptions. So they could continue to afford the basic necessities such as food, utilities, and gasoline. In addition, if Americans feel that the prices of consumer staples will keep rising for more than 12 months, then some hoarding may occur the same way that we saw panic buying of toilet paper in the early months of COVID-19. So, if that's your view, one way to express the view in your portfolio is to select manufacturers and retailers of basic necessities who enjoy relatively inelastic demand. So in our example, our simple example, let's say that based on your research, the grocery chain named Kroger Stores, has particularly strong competitive advantages, blah, 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 such as healthy balance sheet, seasoned management, good real estate locations, high brand awareness, et cetera, et cetera. That would enable the firm to exploit the unfolding opportunity of an inflationary period. And maybe the share price is currently cheap by your earnings growth forecasts. So you decide to buy shares of Kroger stock. So that's piece A. Piece B is of your portfolio is where you express your concerns about the overheated capital markets. So you realize that stocks are looking vulnerably expensive. U.S. equity indices have price to earnings multiples that are now around 30 times, maybe a little higher, which is, let's say, maybe roughly in the upper 80th percentile of actual PE ratios over the past 150 years. So it's on the expensive side. So what can a hedge fund manager do to offset any possible losses in case Kroger shares fall, not because of fundamental problems, but because of a major market crash? So one simple strategy to express this negative view of the broad equity market is to add to your portfolio a short position in an instrument that replicates or is a proxy for the broad market. In this case, maybe what you can do is identify an exchange-traded fund that tracks the Dow or NASDAQ or S&P 500, and then you short that. So you stand to make some compensatory trading profits if the worst ever does materialize. So that's what a hedged portfolio would be.
So, Gerald, in an attempt to recap, may I say that hedge funds are all about limited or zero regulation. You mentioned that a while ago. And this permits them the latitude to experiment with ingenious investment strategies that are not usually employed by other fund managers. Uh, and they can use different asset classes. Does that sound about right? Or did I capture it correctly?
Yes, sir, you did. That's correct. And let me further drive home the point about hedge funds' flexibility to straddle asset classes. It's really less about the breadth of asset classes and more about the breadth of strategies being used. Funds that are available to the general public tend to organize their portfolios according to asset class. There may be one or more asset classes. For the most part, mutual funds or UITFs outperformance of its benchmark depends on the skill of security selection within the defined asset class or classes. In contrast, hedge funds are all about method or strategy, and asset classes or individual securities are merely of secondary importance. One may build a hedge fund that's focused on just one single asset class, in fact, and there are lots of hedge funds that do so. But the behavior of that portfolio in terms of returns, risk, and correlations will look very different from the ways in which the investments are combined and managed. They'll look very different from the asset class that you're using you're taking the different securities from. A good way to differentiate between traditional retail funds and hedge funds is to borrow concepts from the kitchen of all places. So you can think of a meal or a dish as being defined by its main ingredient, maybe chicken, beef, broccoli. This is analogous to viewing a mutual fund as being constructed out of an asset class. However, other types of dishes are better defined by the cooking method, such as casserole or barbecue or stew. And this is an analog for hedge funds. But let me circle back to the issue of regulation. The relative lack of regulation allows hedge funds to try out combinations of unconventional and new strategies that would hopefully result in the desired performance profile and the risk metrics that would set them apart from traditional funds and hence offer value as alternatives or diversifiers.
At least we have some basic understanding of the thought process that goes into a hedge fund construction and management. So, can you give us a quick tour of the universe of hedge funds? If retail funds are commonly classified as equity, fixed income, and multi-asset class funds, then what are the major buckets into which we can sort hedge funds in?
Thank you for the question, Boyat. Let me offer a this is just suggested, taxonomy for hedge funds according to the dominant strategies, at least those that I've seen. Please bear in mind that many hedge funds take a very eclectic approach. They promiscuously mix and match, and they blend strategies from different categories. But we'll walk through what the basic categories are. I should also inject the disclaimer that what you'll see on this slide, this galaxy map of hedge funds, it's by no means exhaustive or complete. I'm surely missing some important types due to the limits of my own experience and research. And a cheap excuse that I can hide behind is the reality that many hedge funds are private and discreet, and they like keeping it that way, maintaining a low profile. Hedge funds are something of a dark universe, but we'll try to shine a light on the constellations. So going back to long short equity funds, one of the more exotic subtypes in this major group is called the short biased hedge fund, which mainly looks at businesses that are expected to perform poorly. In many cases, the managers of short biased funds take a strong contrarian view because their deep research has supposedly uncovered weaknesses or even potential misrepresentations that the rest of the capital markets may not have yet cottoned onto. Then there are so-called equity market neutral hedge funds, which, as defined by Investopedia, quote, seeks profits regardless of an upward or downward market environment, typically through the use of paired long and short positions or derivatives. These funds can potentially serve to mitigate market risk as they seek to generate positive returns in all market environments, unquote. This type of long-short equity fund seems to adhere most closely to the spirit of Alfred Jones. And finally, there's directional quantitative hedge funds, which also employ paired long and short positions for hedging purposes. But in contrast with the market neutral funds, they will adopt a portfolio-wide net long or net short position rather than a neutral position. And that will depend upon whether the equity markets are bullish or bearish, respectively, in their reading. So that's long short equity category. The next family of funds, or galaxy, if you will, is global macro, which studies underlying economic variables and how those may impact the value and trading behavior of a variety of asset classes and geographies. Some popular macro funds prefer to focus on specific asset classes such as currencies or commodities. Some will give more importance to qualitative analysis by experienced analysts or fund managers, and others will be more quantitatively oriented. And still others will resort to a combination of both. Another distinct approach in hedge funds is called relative value, where the manager hunts for mispriced investments that otherwise should be priced similar to similar investments, priced close to similar investments. So in the case of, say, fixed income focused RV hedge funds or yield alternative focused RV hedge funds, the manager will look at pairs of bonds or pairs of loan derivatives or pairs of real estate investment trusts that are of similar nature and credit risk grade and devise strategies based on the anomalous gap between the yields. Other types of RV hedge funds compare the volatilities of similar instruments, particularly equities or equity indices, and sometimes commodities and currencies as well. So the volatilities that I'm referring to here are the anticipated volatilities implied by the call or put options. So this is also, this uses the signals given off by derivatives. The fourth big group of hedge fund strategies is called event-driven, or ED. So if there are any male senior citizens in the audience, no, it's not that kind of ED. So this is event-driven. According to hedge fund data provider HFR, ED, or event-driven funds, quote, maintain positions in companies currently or prospectively involved in corporate transactions of a wide variety, including but not limited to mergers, restructurings, financial distress, tender offers, shareholder buybacks, debt exchanges, security issuances, or other capital structure adjustments, unquote. So that gives you an idea of what ED funds are like. There's a special type of event-driven fund called an activist fund, which actually tries to use shareholder and board representation to catalyze a desired event such as a merger, divestment, spin-off, governance shake-up, special dividend, change in strategy, or other major corporate actions that should hopefully impact the value of the firm's target equity or debt securities. Other notable event-driven subtypes are those which specialize in equity arbitrage, such as buying shares of a merger target if these are below the tender offer price, or shorting the shares of the acquiring company where appropriate. And another kind of ED is distressed equity and or debt paper. That is a practice known as bottom fishing. A relatively small but interesting hedge fund niche is called risk parity, in which the manager defines a certain level of risk, often but not in all cases expressed as a volatility percentage. And the entire portfolio shall strive to maintain and then that targeted volatility amount. And the manager then proceeds to assemble investments, the components of the portfolio, for that portfolio from a wide range of asset classes as is available. And the guide to allocation at both the asset class and individual security level is risk contribution. So the objective is to assemble the highest return portfolio positions and size them to spit out the chosen overall risk level for the portfolio. So you're optimizing for risk. That's what you're doing in risk parity. Another important niche is systematic hedge funds, which employ trading strategies written out as software programs, as algorithms, such that humans have little or no participation, no intervention during trading hours. And instead, humans are those who are involved in creating, developing, writing, testing the algorithmic strategies. Some systematic funds engage in short term trading, which in turn is premised on technical analysis of prices and trading volumes of securities. On the other hand, there are other types of systematic funds which base their algorithmic strategies on metrics associated with fundamental analysis. And then, of course, there are funds of hedge funds that are available, which investors often which offer investors their own curated baskets of hedge funds. And finally, there are those other hedge funds which simply refuse to be typecast. They're difficult to pigeonhole because their combination of strategies may be too eclectic. Um, so that there's other isolated types of one-off hedge funds that exist as well outside of the major galaxies.
Wow. Uh, Gerald, you successfully removed our hunger. But as my students or participants in trainings would always say, sir, you have successfully given us a nosebleed right now. Anyways, uh, it's a bit of an overload, but still, it's very important information for all of our well potential clients, perhaps, or those members of IARC Philippines who are watching us right now. So, thank you for defining hedge funds in the broadest term and taking us for one level deeper to survey the major categories that are available. Can you take us more, at least one more level down, and name some specific examples of hedge funds? What are the biggest hedge funds that are found on the planet?
Sure, Ryan. Thank you. First of all, my apologies for the nosebleed. But I'm very happy to mention a few hedge funds, but it's a little difficult to answer the question of what are the most notable or the biggest hedge funds around, because there's no single authoritative ranking uh, according to assets under management or AUM. I do have a couple of slides which I'd like to show to our audience. These are league tables from sources that I believe to be reputable, but on closer inspection, maybe some of them have some imperfections. I will have to again hide like a coward behind the excuse that since hedge funds are not regulated and are quite private, then there's no real public disclosure requirements. But let's proceed anyway. I'll show you what I mean. This next table, which is extracted from the website Pensions and Investments, provides a listing of about 109 of the biggest hedge fund management companies or complexes in the world as of the middle of 2021, so June 30th last year. Almost all of these firms offer more than one hedge fund product. Sorting the table according to size of assets under management or AUM, the left half of your screen of the slide shows the 20 biggest managers with AUM starting at $106 billion and going all the way down to $20 billion. The right half of the screen shows a few additional names lower down the list that I personally find notable and which you may wish to find out more above when the audience has time. The Pensions and Investments website does not claim to keep an exhaustive list. So even if you see that all 109 managers in this database represented an aggregate AUM of $1.32 trillion as of the end of June last year, you can be 100% certain that even this staggering number is just the tip of the iceberg. According to a January 2022 article by Reuters, January 20th of this year, the global hedge fund industry's AUM is estimated by hedge fund database HFR to have breached an unprecedented $4 trillion dollars worth at the end of 2021. On the other hand, it seems to me that the website took some care to account for only hedge fund portfolios and exclude the AUM of other product types such as retail funds, private equity, etc. As an example, in this list, you'll see that BlackRock makes it only to number 16 with AUM of 23.1 billion. Clearly, BlackRock is far larger than that, as it is a supermarket for all sorts of portfolio products and for retail and sophisticated investor segments. I suspect that Pensions and Investments website works only with what it can research, which is publicly available information. So it's not a comprehensive database. What I feel is the use of that listing is that it recognizes prominent manager names, those management houses that try to cultivate a prominent footprint in media and or the public and are well known to institutional investors, such as pensions. Over to the next slide, we'll see a ranking of individual hedge funds, not hedge fund managers, but individual hedge fund products, ranked again by AUM as of early March this year. And this is extracted from another hedge fund database, which is called Eureka Hedge. So like Bloomberg, Eureka Hedge works on a subscription basis, and subscribing hedge funds voluntarily report their own performance, AUM, and other information in exchange for visibility over their competitors and the entire industry. So our filtered search as of March 8th of this year yielded a total of more than 7,400 unique hedge funds with combined AUM of 3.25 trillion US dollars. So that's an amount considerably closer to the 4 trillion that was cited in Reuters in January, and may possibly reflect some decline in market value or some net redemption since the start of the year. After all, this was just a couple of weeks after that rude shock of the Russian invasion in Ukraine. So what surprised us was that the largest single fund in Eureka Hedge's database, you'll see that it's called Millennium Global Estate LP, had AUM that was actually twice as large as the preceding list's top manager, Bridgewater Associates. And in the preceding list, Millennium Management only ranked fourth. So numbers-wise, I feel more comfortable with this single fund ranking by Eureka Hedge. But again, the utility of the previous slide is more for the prominent names that you may also want to look into.
Gerald, this has been a very invaluable spotlight that you have shown to us and made us discover the hidden world of hedge funds. And I'm sure once the audience get their hands on copies of your presentation deck, they will look at the last two slides and ponder over and then go over the illustrations on those slides. But let's move on to the topic of performance. What can you share on the overview of how hedge funds as an asset class may have historically delighted or disappointed investors?
Thank you, Boyet. So let's take a look at the big picture in terms of hedge fund performance. So what I've put up here on this slide is the Eureka Hedge Fund Index, which is that data provider's main proprietary benchmark, a basket of roughly 2,200 individual hedge funds across a representative range of strategies. This chart shows us how over the past couple of decades, the index has generally risen, except for a couple of important dips. Crunching the numbers, we see that in the 22 years from the start of 2000 through the end of last year, the index's compound annual growth rate was 8.59%, a decent result, but as we shall see later on, less exciting than some other asset classes. Keep in mind, however, that hedge funds are alternative investments intended to serve diversification purposes against other asset classes that an investor is already presumed to have, almost certainly traditional asset classes, and possibly other alternatives such as private equity, real estate, commodities, etc. Because of their role as diversifiers, it is more relevant to assess hedge funds using both return and risk metrics. So everyone in the audience is likely to have heard of the concept of volatility because it's the popular, conventional go-to risk metric. Without going into the math, volatility gives us a rough sense of positive or negative variability for a given statistic, such as rate of return or CAGR. The formula for volatility is an extension of the formula for standard deviation, which presumes a normal distribution of up and down variability, and at bare minimum is a symmetric distribution. Of course, real life tells us otherwise. In the capital markets, the behavior, the distribution of returns is absolutely not normal. It's not even symmetric. So much ink has been spilled over why we are still using volatility as a risk measure to convey an investment's riskiness. But more on that later. Suffice it to say for now that Eureka Hedge's main index for the time period showed here, 22 years, works out to about 5.11%. So next, if investors wish to have a feel for whether an investment might be too risky given its level of return, or conversely, it generates tepid returns given its level of risk, then all they need to do is to simply divide the return number by the volatility number, by the risk number. So in this case, the ratio that emerges tells you that you prefer a higher number because this is the scenario where your numerator, the return, overpowers the denominator, which is the risk. So if we plug CIGR into the numerator and volatility into the denominator, the resulting ratio is called the risk-adjusted return ratio. If this looks suspiciously like the Sharpe ratio, your eyes are not deceiving you. It's a stripped-down version of the Sharpe ratio, which subtracts, as you know, the risk-free rate in the numerator. So for the 22-year historical period, the Eureka Hedge main index's risk-adjusted return ratio is calculated at 1.68 times. Let us now use our risk and return framework to compare hedge funds with other asset classes. So this slide that you're looking at presents a scattergram where each dot represents an asset class index plotted against two axes, with the x-axis being performance, the y-axis being performance, the horizontal axis being performance. Specifically, the y-axis is the vertical axis, which specifically means the 5-year CIGR. And the x-axis is the risk. The horizontal axis is the risk. In this case, it is 5-year volatility. The red spots denote equity benchmarks. The green ones are fixed income. The blue dots are commodities. The yellow dots are real estate investment trusts. And the black dots are hedge fund indices. On this chart, the S&P 500 provided the highest annual return for the 5-year period ended December 2021, with a CAGR of more than 18%, whereas the PSEI in dollar terms was the laggard in the sample with a CAGR of slightly less than 1% per annum in US dollar terms. Risk-wise, so if you look from left to right, the leftmost data point or the lowest risk data point corresponded to US Treasuries, which had a volatility of 3.36% per annum, whereas the highest volatility of nearly 39% was posted by the Dow Jones Energy Commodity Index. So you can check out in detail the actual values on the table on the right side of this slide. Any investor would naturally agree to a reasonable trade-off between risks and returns. Ideally, modestly yielding investments should have low risks associated with them. So you should be on the lower left-hand side of this chart. And higher risk demands compensation in the form of higher returns. So you would expect that high return and high risk types of investments would cluster around the upper right portion. But in reality, the last 5 years shows us that different asset classes do not conform to our expectations, um, because we see that there are low risk, high return investments which are in the upper left portion of our chart, and we have what I like to call the no-fly zone in the lower right portion of this chart, where you suffer from low returns and high volatility. So if you'll recall your high school algebra, the ratio of return to risk, which is the value of y divided by the value of x, is nothing more than the slope of the line that you can draw from the origin to a given data point. And voila, that's the risk adjusted ratio that you have there. So the slope is like the hypotenuse of a right triangle that connects the origin, uh, the intersection of the x and y axes, and a given data point. So the next question is, how did hedge funds as a whole fare against other classes during 2017 to 2022? So at the bottom of the table on the right, you'll notice that there are two HFR benchmarks, which are the HFRI 500 Composite Index, which is all strategies, and the HFRI 500 Equity Hedge Index, which is equity long short strategies. So in terms of pure performance of CAGR, neither hedge fund index posted stellar or atrociously bad returns, but were in the middle of the pack. In terms of pure risk or volatility, they ranked pretty well, with low volatilities in the single digits. 8.52% for the long short equity benchmark, and 6.44% for the broader hedge fund benchmark. But what really shone were the risk adjusted profiles, the risk reward profiles of these indices. So the risk adjusted return ratio for HFRI equity and HFRI composite ranked second and third best, respectively, just behind US Treasuries and ahead of all other asset classes.
Gerald, these are great findings, and they really support the proposition that hedge funds are great alternative investments or asset classes because they offer investors reasonable trade-offs between risk and performance. So the data backs it up. So kita natin na pwedeng mag-perform ng maganda at makakatulong. So,
Well, Ryan, it gets even better. So let's go to the next slide.
wow, really Sige, I'm so excited to see that.
I want to show you what happens when we replace volatility with maximum drawdown in our as our risk metric in the horizontal axis. We're still using the same y-axis, which is the CAGR, and so each asset as data point still sits at the same altitude, kumbaga, on the scatter chart as it does on the preceding chart. However, the drawdown reveals the full extent of each asset class's risk, which is the absolute worst that each index sank during the 5-year slice of time. So you can see that the data points are more horizontally stretched out. They're more dispersed. Energy still ranks as the worst in terms of risk, moving quite far along to the right of the x-axis. The maximum drawdown that energy suffered at one point in 2017 to 2021 was a whopping 74.44%. A roller coaster not suited for the faint-hearted. So at one point, you were down 74% from that most recent peak. As with the previous chart, the ratio of performance to risk has its own special meaning. In this case, the CAGR divided by the maximum drawdown is the MAR ratio. And so in the same way, one can draw a line from the origin to any data point, and the steepness of the line will tell you what the MAR ratio is. And the steeper the slope of the line, the higher the MAR ratio. So the useful takeaway from this chart is the conclusion that the two hedge fund indices actually improved upon their risk-adjusted performance rankings. So before, the two hedge fund indices were ranked 2 and 3. Now they're ranked 1 and 2. Having displaced US Treasuries. US Treasuries is now ranked number 3. in terms of risk reward profile. So that's why I said it actually looks better when you look at a more conservative risk metric.
What a very compelling case for hedge funds, huh, Gerald? Um, Maybe we should all go out and look for the nearest hedge fund manager as soon as we end this podcast.
I wish it were only that simple, Boyet. There is, however, one more crucial aspect to consider, and that is diversification. In the interest of transparency, I ought to show everyone our findings regarding the correlations between hedge funds and other asset classes, because correlation is inversely related to diversification value. This means that the less correlated hedge funds are with other asset classes, the more valuable they are, the stronger the justification they have to add hedge funds, that you have to add hedge funds to a portfolio dominated by other asset classes. Unfortunately, the same 5-year data that we used for the prior analysis, scatter charts, reveals that the two HFRI hedge fund indices are moderately positively correlated with most other asset classes. So what you're looking at on this slide is a matrix of correlations, or more academically speaking, Pearson correlation coefficients, which are denoted by the Greek letter rho. Rho, which varies between negative 1.0 and positive 1.0, tells you the strength of the relationship between any pair of benchmarks denoted in the row and column of this matrix. So a row value of positive 1.0 means that that whatever pair of things that you're comparing are perfectly correlated, meaning that they move completely in sync, rising or falling simultaneously and by the same magnitude. A row of negative 1.0 means that movements are perfectly mirrored. They are in opposite directions but equal in magnitude. And in between them, a row of 0.0000 indicates no discernible relationship, and that the two things are moving completely independently of each other, and sometimes in the same direction, sometimes opposite, and sometimes in different magnitudes or the same. This table has the advantage of being automatically color coded, like a yellow, red, green stoplight, red, yellow, green stoplight, but with shades and gradations. So the closer that a box is to pure or deep red, the closer the row value is to the maximum value. In this case, 1.0, a correlation of 1.0, or a row value of 1.0. And the closer to dark green or deep green, the closer the value is to the minimum. In this case, the minimum in this grid is negative 0.56, which incidentally, this value 0.56 is the row that describes the relationship or the correlation between the Nikkei 225, which is the third column from the left, and US Treasuries, the seventh column from the top. So if you combine those two asset classes, if it's just those two asset classes in your portfolio, you should do quite well. You're extremely well diversified because the correlation between the two is a large negative number. It's the best negative number that you can find in this table. Have a look at the bottom two rows, which are the HFRI hedge fund indices. You'll observe that they are mostly some shades of red or orange, indicating that they have elevated positive correlations with many other asset classes. And therefore, adding the hedge fund indices to a portfolio can be somewhat of a redundant gesture, where hedge fund indices row numbers showed relatively low positive values, where when these were paired with US AAA's corporate bonds, Philippine bonds, grains, and gold. The HFRI indices had negative correlations with US Treasuries, but then every other asset class was also negatively correlated with US Treasuries.
So, what conclusion then can we draw from this analysis of correlations, Gerald?
Well, Ryan, on the face of things, we must concede that the hedge fund index correlation numbers are not as attractive as we would like them to be. But of course, it's easy to make sweeping generalizations, both favorable and unfavorable, based on asset class benchmarks. If all you wish to do is passively track an index, that's perfectly fine, and you may invest in real life portfolios that do so. So, similar to mutual fund ETFs, there exist investable hedge fund index portfolios as well that you can invest in, and hedge fund factor replicators that you can also invest in. However, it would be good to remember that an index is always a condensed or summary indicator, a panoramic snapshot that cannot reveal the fine detail, and less passive investors always have the option of descending one level further uh, and looking at particular hedge funds, and they will see right away that the hedge fund asset class is far from homogeneous. Let us first lay on the table, for easy reference, the performance and risk stats of the indices being maintained by these two subscription databases, HFR and Eureka Hedge. Here are their CAGRs, drawdowns, maximum drawdowns, and MAR ratios for the last 5 calendar years. You'll see that the numbers seem to broadly agree. But next, we should dive into the forest and evaluate the individual trees. So we opened up the Eureka Hedge database and sorted the CAGRs, maximum drawdowns, and MAR ratios of all of the unique reporting hedge funds covered in the same 5-year period. So there were about 2,200 of these funds, and these were the ones that were reporting their NAVs on a regular basis. Again, this is voluntary reporting. So in some cases where hedge funds were not doing too well, maybe they weren't bothering to report. Anyway, and of course we excluded those which were younger than 5 years old, because you don't want to have to make up data for fictitious data for funds that are not of the same vintage. So what immediately jumps out at the reader is the wide range of values defined that we discovered in our sample. For all 3 metrics, for CAGR, maximum drawdown, and MAR ratio. So have a look at the span of returns showing the 5-year CAGR. The best 5-year CAGR is almost 94%. So that's for 5 years. And the worst 5-year CAGR was nearly negative 33%. So with the best performing hedge fund, if you had invested at the start of 2017 $100,000, that would have and you would have ended 2021 with 2.7 million US dollars. So that gives you an exit multiple of 27x, and that's handsome in any book. That assumes, of course, a couple of lucky tricks. First, you somehow got introduced to that hedge fund before 2017, which is no easy feat given that these funds don't aggressively broadcast their existence. And then second, you had a crystal ball or a genie that confirmed to you that, yeah, this fund was the lottery ticket. This was the winning lottery ticket. So you had to be that lucky to get that kind of a return. At the opposite extreme, you had to be extremely unlucky if you had sunk 100,000 US dollars in the laggard fund, and you hung on for the bitter 5 years without making any redemptions whatsoever. Your initial investment would have become worth 100,000 US would have become 13,800, which means an 86.2% loss on principal. So that's the diversity in possible outcomes if you invest in an individual hedge fund. There's also a similar feast and famine contrast that's going on in terms of maximum drawdowns, in terms of risk. So we found that 12 of the 2,200 hedge funds in our sample experienced 0 drawdowns during all those 60 months, all those 5 years. And that's a stunning feat. Those 12 funds experienced no dips whatsoever. Majority of these, of course, were quite conservative, and so most of them were not stellar performers in the CAGR requirement. At the other end, there was one fund that at one point had endured a drawdown of more than 99%. And that was a temporary drawdown. But thankfully, it recovered from the plunge and not only survived, but performed respectably as far as latecomer investors are concerned. Because some investors could have started investing while the NAV was in its valley. So the fact that that laggard fund had stuck around for 5 years is a testament to two things. One is the grit of the manager, and number two is the trust and faith of the investors.
I think, Gerald, the highlight in this slide is that um, life is not a box of chocolates, and we can never tell what risk return profile our hedge funds profile is gonna have, di ba? In other words, caveat emptor or buyer beware. So put a lot of care in selecting the hedge funds you might be investing in. Perhaps our viewers may find benefit in looking into the underperforming or highly risky hedge funds, because it's often when things don't work out well that we can pick up the best lessons.
That's perfectly true, Boyat. I mean, when you don't get what you want, you get experience.
Yes.
So the the history of investing in hedge funds is littered with failed hedge funds and hedge fund managers. Certainly, in all asset classes, that's true, but disproportionately so in hedge funds, which may be why hedge funds have acquired a checkered reputation in the public's mind. I think a lot of the hedge fund blowups and disasters are due to their inherent nature as experimenters and innovators, plus the fact that their managers have high levels of conviction and they resort to a lot of leverage. There's more that can go wrong if you're attempting to explore uncharted territory. In other cases, however, failures are caused more by overconfidence, by forgetting important risk mitigation basics. And in other cases, there's outright malicious intent. As a public service, let me therefore walk you through some of the more spectacular and memorable failures in the hedge fund space. The fourth biggest collapse that we're aware of is very recent. In fact, it only happened last year, March 2021. This is Archegos Capital. Technically speaking, Archegos Capital is not a hedge fund because it's not a collective vehicle. It was fully owned by Bill Huang. So it's a family office. But Bill Huang used to be a hedge fund manager himself. He had his own fund called Tiger Asia. In turn, Tiger Asia and Bill Huang are what were known as Tiger Cubs, one of about 50 asset managers who were mentored and incubated by the legendary Julian Robertson, who used to run Tiger Management from 1980 to 2000. So Bill Wang, before Archegos Management and before Archegos Management collapsed, Bill Wang was in charge of Tiger Asia. He was the founder and the head. But that fund had to be dissolved in 2012, partly due to disappointing results, and also because Wang and Tiger Asia were forced to settle criminal charges of insider trading. So Bill Wang's second act was supposed to have been Archegos, which ended not in the redemption of his reputation, but with margin trading obligations that were called in by his lenders, which included Credit Suisse, Morgan Stanley, Nomura, and Goldman Sachs. And what happened tragically for Bill Wang is that Archegos had been building up dangerously high levels of gearing, and none of the banks was aware that of the full extent of the leverage. Partly because Bill Wang was hiding behind instruments called they were called total equity return swaps, and these are not very exotic derivatives. So any one of Archegos's banks would know and approve Archegos's use of these total return swaps, equity swaps, but they had no idea that other banks were also doing the same for him and were trading those swaps for the benefit of Archegos. So for a very long time, no single bank had a full picture of Archegos's complete level of leverage, which was pretty high already. In the meantime, Archegos was taking advantage of its anonymity to allegedly, at least, engage in stock price manipulation without its banks knowing that they were being his pawns. They were acting as his pawns. Our fifth in the list, and probably the last that I will talk about. I will leave the others for the audience to look at their leisure. The fifth one is Tiger Management itself of Julian Robertson. So he had a 2-decade career, in the long short equity space, and ended not with a bang but with a whimper. As his high conviction style of fundamentals based equity investing ran into trouble toward the close of the 20th century when the dot com mania radically decoupled business fundamentals from irrational speculative trading valuations. We all know what the dot com mania looked like. And so after that, he put up his coat and liquidated Tiger Management in an orderly fashion.
Gerald, medyo natakot kami ng konti dun sa mga shinare mo. But I guess, hindi lang naman doom ang nangyayari sa hedge funds, di ba? Maybe you can share with us which hedge funds performed best in the last 5 years, from 2017 until 2022. Which among these companies had the best CAGR?
Thank you, Ryan. Yeah, I apologize for reinforcing everybody's phobias about hedge funds and getting you all depressed about all the things that can go wrong. No? But you know, um, let's go with your suggestion and let's take a look at some of the better performing hedge funds in the last 5 years. So as a parting gift, here is a list of the 20 best performing hedge funds over the past 5 years, 2017 to 2021, according to the database of Eureka Hedge, sorted by descending CAGR and showing location, primary strategy, AUM, maximum drawdown, and MAR ratio. So if you do nothing but look at this chart, then that's not a bad starting point for a hunt for suitable funds. In case anybody in the audience should wish to research individual names, you're most welcome for this, and we're not charging for that.
Oh, thanks, Gerald. That's ending on a very high note, and we certainly found this to be a very enlightening podcast episode. And I would suspect a good chunk of our viewers would appreciate the knowledge that you have shared.
Thank you, Boyet, and thank you, Ryan. Many thanks to both of you and to the leadership team of IARFC, including Miss Grace de Vera Escobar, for suggesting that we do this episode on hedge funds. Thank you for the invitation. It's an honor and privilege to be of some use to a great organization such as IARFC Philippines.
So on behalf of the organization, Gerald, let me thank you on behalf of IARFC Philippines. And we really appreciate the time, the effort, and the detail that you have shared with us in learning about hedge funds tonight.
Gerald, we truly thank you for your generosity and for the many things that we learned about hedge funds. People, please do watch out for season 5. We have concluded season 4 with this episode, and we have a treat for you, for all of you. Our friends from the USA are back due to insistent public demand. So watch out for season 5. Our friends from IARC USA will visit us once more. The first episode will be aired on the 4th Tuesday of June 2022. So for our RFC public courses, please do watch out for announcements and visit us in the IARFC Philippines Facebook page for schedules. And we would also like to remind everyone, all of our RFC members, of their membership renewal. For your membership renewal information, please do contact Miss Arlene Baguyo at iarfcph@gmail.com, or you may text or call her through 0917-645-7846.
Our podcast episodes are shown every second and fourth Tuesday of the month. That's why it's important to follow us on Facebook. Episodes are pre-recorded and broadcasted through Facebook Live. So on behalf of our executive producer, Ms. Grace de Vera Escobar, this is the RFC Tuesday podcast saying,
It's better to be in the know than to be the last to know.
thank you and have a pleasant evening, everyone. See you in the next podcast.
Good night. Stay safe. Thank you, Jay and Gerald. Thank you again for being with us.
Thank you.